It's over. The speculation, the theories, the years of analyzing charts and wondering when the dam would break, that phase is concluded. This morning, while the mainstream financial world was still asleep in a post-Christmas haze, the dam didn't just crack, it was obliterated. It was wiped out by a wave of cold, hard data that confirms every single warning about the fragility of the paper financial system. At 8:00 a.m. this morning, the Federal Reserve Bank of New York's overnight repurchase agreement facility, think of it as the emergency pawn shop for the entire banking system, recorded a single transaction of $17.25 billion. Now, let me be clear. This is not some normal end-of-year window dressing. This is not just operational liquidity. This is a tourniquet being applied to a catastrophic wound. A healthy, solvent bank with a balanced book does not go to the Fed's emergency window, especially not on the quiet Friday right after a holiday. Doing so is the walk of shame. It's a public admission of desperate, critical illiquidity. So the only question is, what triggered a bleed so severe that it required a $17 billion transfusion before the morning coffee was even cold? The answer is right there on every commodity screen in the world. Silver, $77.16. The timing is not a coincidence, it's causation. This is the sound of a historic margin call hitting the books of the global bullion banks and the banks not having the cash to pay it. Let's break down the mechanics of this failure. The bullion banks have maintained massive short positions in silver for decades. It's been a fundamental pillar of their price suppression scheme. Their model relied on infinite paper leverage, selling contracts they never intended to cover, always believing they could manipulate the price back down. For every single dollar that silver rises, these shorts lose billions. For years, they could hide these as unrealized losses, just kicking the can down the road. But a $5 vertical gap in just 24 hours? That's an earthquake that shatters that kind of accounting fiction. At $77 silver, the losses on hundreds of millions of ounces of paper shorts became too large to ignore. The clearinghouse, the neutral entity that guarantees all trades, doesn't care about long-term theories. It performs a mark-to-market calculation and issues a margin call. Post the cash to cover this immediate risk, or we liquidate your entire position. This morning, that calculation yielded a number the banks simply could not meet from their own reserves. On a mark-to-market basis, they were technically insolvent. So what did they do? They gathered their last unencumbered collateral, most likely U.S. Treasury bonds, and they ran to the Fed's repo window. They exchanged them for $17 billion in emergency cash just to survive the day and avoid a forced liquidation that would have sent silver to $100 before lunchtime. This is not a conspiracy theory. This is the logical, mechanical outcome of excessive leverage meeting an immovable object of physical demand. And that physical demand is quantified. The number is apocalyptic for the paper system. The CME's daily delivery notice report for December, released this morning, shows 12,777 contracts standing for delivery. Each contract is 5,000 ounces. Do the math. This is a demand for 63.9 million ounces of physical silver, that's nearly 2,000 tons, in a single month from a single exchange. To put that into context, this represents roughly 8% of the annual global mine supply. This is not just speculative paper rolling over. These are industrial and strategic players, sovereign wealth funds, battery manufacturers, supply chain managers, holding their contracts to expiry and demanding the physical metal itself. They are sending an unambiguous message. We do not want your cash. Your cash is melting. We want the element. This demand is colliding with a physical system that's already in crisis. The COMEX registered inventory, the actual metal available to deliver, has been in a parabolic drain for months. The vaults cannot satisfy 64 million ounces. The banks, now short and needing to deliver, are forced to become panic buyers in a market that's screaming higher, creating a feedback loop of their own destruction. Simultaneously, a silent but equally telling capitulation occurred in the ETF space. The cost to borrow shares of the iShares Silver Trust, or SLV, to short it, which had been elevated, collapsed today to near zero. At the same time, 10 million new shares became available to borrow. The mainstream narrative will falsely claim this means the squeeze is over. The truth is the exact opposite. A collapsing borrow fee means the demand to short has evaporated. The leveraged speculators, the hedge funds that would typically rush to short a $5 rally, have looked at the repo spike, they've looked at the delivery notices, and they've looked at the geopolitical landscape, and they have fled the battlefield. They are returning borrowed shares and refusing to put on new shorts. They are not selling, they are surrendering. This removes a critical source of selling pressure from the paper market. The ceiling provided by these speculative shorts is gone. We are now in a market where the only sellers left are the bankrupt banks, who are being sustained by Fed liquidity, and the physical holders, who have no reason to sell at any price under triple digits. This creates the Fed's inescapable doom loop. the very trap they sprung with their own $17 billion injection. By printing money to bail out banks suffering losses from a rising silver price, the Fed has explicitly chosen to sacrifice currency integrity to preserve banking solvency. This is an inflationary policy, full stop. But here's the fatal flaw. Printing dollars to suppress a crisis caused by currency devaluation guarantees more currency devaluation. It validates the very reason people are buying silver in the first place. So the bailout itself pushes silver higher, which triggers larger losses for the banks, which then demands larger bailouts. The Fed is trying to put out a fire with gasoline. They have become the ultimate bag holder for the silver short position, and they are armed only with a printing press that destroys the value of the money they print. This formally establishes a Fed put, not under the stock market, but under the silver market. Any significant decline in price risks breaking the banks again, triggering more printing. Any rise is fueled by the inflationary consequences of the previous printing. The downside for physical silver has been surgically removed by central bank policy. Therefore, the road to $100 silver is no longer a speculative chart target based on supply deficits. It is a policy certainty baked into the Fed's reaction function. That $17 billion was not just a loan, it was a regime change. It announced that the tightening cycle is over and the infinite liquidity phase has rebooted. When the banking system is threatened by a shortage of real money, which is silver, the central bank will respond with infinite quantities of fake money, which is dollars. The nominal price of the real money must adjust to infinity to reflect this exchange. All the old price targets are now obsolete. We are in a currency repricing event. The immediate implications are clear. The volatility will be extreme as this wounded beast thrashes around. The banks, armed with their Fed cash, may attempt one last violent paper smash to try and break investor psychology. Recognize this for what it is. A death rattle, not a reversal. It would only make physical metal cheaper for the sovereign and industrial buyers who are already draining the vaults. Watch the premiums, not the spot price. The difference between the paper quote and the price to secure a real bar is the truth gauge. When premiums explode, the spot price is a lie. Most critically, prepare for the unobtainium phase. That 63 million ounce delivery demand is going to suck the wholesale market completely dry. And when the wholesale inventory vanishes, the retail buy button disappears. The price for new buyers becomes effectively infinite. The time for hesitation is past. We are witnessing the conclusive transfer of wealth from the financial to the real. For 40 years, paper claims on productivity, derivatives, bonds, unbacked currency, appreciated while real assets were suppressed. That era ended this morning at the Fed's repo window. The $17 billion was a flare illuminating the battlefield, revealing a banking system in full, desperate retreat, sustained only by the perpetual motion machine of currency debasement. You're not merely holding a medal, you're holding a claim on reality in a system that has bet everything on a fiction. This morning, that fiction has demanded its first major bailout. There will be more, each one larger, each one more destructive to the currency, and each one acting as rocket fuel for the only thing they cannot print, physical silver. The game is indeed rigged, but it is now rigged irrevocably in your favor. Hold the line. Thanks for watching. Be sure to subscribe for more updates as this story unfolds.